Hey YouTube, yesterday the market fell big, and when the market falls big, I get excited because I start looking at my portfolio and I start looking at the stocks I own and I check if I can add to any of my positions. The market is not cheap right now, I would say. It's still not at the level I would like it to be before I start buying aggressively. I would much rather have the market be in the red zone over here where there's a lot more fear so I can start buying more. But that may or may not happen. And so I gotta take a look at my holding today and see if it's worth adding. And that's what I plan to do in this video. So on the screen, I have the Y charts software, and I'm going to use it to look at all my top holdings. You can see here I have my top holdings selected, Amazon, Facebook, Alphabet, and so on over here. I also included some of my speculative plays like Trilio, Beyond Meat, and Upwork. I probably will not look at these three stocks in this video, but if you would like me to take a look at these three stocks as well in a separate video, let me know in the comment section. So what are the metrics I'm going to look at for my top holdings? Well, these are some of the metrics I plan to look at. Right now on the screen you see the revenue, the quarterly year-over-year growth. I think revenue growth is important. That plays a factor in determining whether there's a good valuation. I will probably also look at the enterprise value to revenues going forward. That's similar to the price to sales ratio. And I'll probably also look at some of the other metrics like enterprise value to EBITDA and also the EBITDA margin. All these metrics play a role in determining whether a stock is currently available at a good value. So first up, let's look at the quarterly year-over-year revenue growth. Most of these companies have already reported, in fact, I think all of these companies have reported their first quarter results. So let's take a deeper dive. So in terms of quarterly year-over-year revenue growth, Amazon has the highest. We know why that is, because it saw a spike in terms of consumers buying more stuff online, especially groceries. So Amazon's quarterly revenue growth is about 26.39%. Next up is Autodesk. So Autodesk has a very healthy revenue growth rate of 20.42%. I'm quite excited about Autodesk as well. After that is Adobe, which is 18.84%, also a very healthy growth rate. And I think both Adobe and Autodesk are now, Adobe has already moved to the cloud model, and Autodesk is transitioning to the cloud model. But they both offer very valuable digital software which can be used from the comfort of your home. And with the subscription model, it's unlikely that companies will cancel their subscription because they provide very essential software. So after that, we have Alibaba with about 18.22%. So Alibaba is another very high growth company which I'm very excited about. After Alibaba is Facebook. Facebook has had about 17.64% in terms of revenue growth during the last quarter. Next up is Alphabet, and then we have Intuitive Surgical with about 12.92%. Then we have PayPal with about 11.87%. Visa with about 6.55%, and MasterCard with 3.09%. So some of these companies were heavily affected by the virus in the first quarter. You can see that Visa and MasterCard have had quite significant declines in their revenue growth rate. But I will expect them to bounce back considerably actually when things pick up. Both of these stocks have a long runway in terms of winning in the war on cash. So before we move on to the next metric, I just want to say that we know that the first quarter was very difficult for a lot of companies. So it may be more accurate to actually look at the past quarter. So if you look at the past quarter, you can see a different picture. While Amazon had about 20% growth, Facebook had 24% growth, Alphabet had 17% growth, Visa had 9.95% growth, MasterCard had 15 plus percent, Intuitive had about 22%, Alibaba was 35% in the last quarter, Adobe was 21, PayPal was 17, and Autodesk was 21. So some companies were very severely affected. You can see MasterCard dropped a lot, and other companies like Facebook, Alphabet, and Intuitive were somewhat affected. Their revenue growth rates dropped quite a bit as well, and Alibaba as well dropped very significantly. But going forward, I think as the coronavirus wanes and the economy returns, we should see something closer to that December ending quarter revenue growth rate. So I think we should look at both revenue growth rates. So before we move on to the next metric, which is the enterprise value to revenue, I just want to look at the operating margin. I think the operating margin will shed a lot of light when we look at the enterprise value to revenue metric. Some of these companies have very big fat EBITDA margins. So naturally the price to sales ratio or the enterprise value to revenue ratio is going to be much higher. So let's take a look at these companies and their margins. So first up, we have Visa with about 69%. So this is an incredible EBITDA margin. Literally, it means like out of every $1 in revenue, nearly 70% is cash flow flowing through that company. So it has a very good EBITDA margin. And next up, and not very far behind, is MasterCard with about 60% EBITDA margin. So both of these companies we will see later in the price to sales ratio have a much higher price to sales ratio than the average company, and it's probably deservedly so because of their very healthy EBITDA margins. So after that, we have Facebook with another very high EBITDA margin, about 45%. Then we have Adobe with about 36.96%. Then we have Alibaba with 36.23%. After that, we have Intuitive with 35.72%. Then we have Alphabet at 30.96%. We have PayPal at about nearly 20%, Autodesk at about 16.49%, and Amazon at about 12.45%. So later we're going to see that Amazon's price to sales ratio is much lower than the rest. And this can be tied to the fact that it has a much lower EBITDA margin because most of the revenue comes from its online e-commerce business, which doesn't have a very high margin. So the other thing to note about the EBITDA margin is that it is usually a good indicator of the strength of the economic moat of a company. The higher the EBITDA margin, that shows that it can keep away its competitors and can charge a lot of money for the service or product it provides. It has a lot of pricing power built into its business model, and that is why the EBITDA margin is so high. So that's another thing to think about when considering the strength of the moat of a company. Autodesk EBITDA margin seems a bit low for a software company. Right now it's about 16.49. But I think this is because it's still transitioning to a SaaS model. So it's not accepting as much revenue as it once was, because it doesn't sell the product as a one-time purchase, but people or customers pay for it now over a period of time. So that has depressed the EBITDA margin. But I think over time we'll see Autodesk will have EBITDA margins closer to what Adobe has, which is about probably near the 30% range. So now let's look at the valuation metric that we have been building up to, which is the EV to revenue. So I use EV because it gives a better indication of valuation. It takes away the cash or adds in the debt that the company has to the market cap, and that's a more accurate indication of the true value of a company. And then we compare that against the revenue. So this is how it shows up on the screen. You can see that Visa and MasterCard have the highest price to sales ratio, and I'm going to use the term price to sales ratio interchangeably with EV to revenue. And and Alphabet and Amazon have the lowest. So I think we will look at each individually, or at least two at a time, so we get a clearer picture. But I think the initial impression is that Visa and MasterCard are high, but like I mentioned in the previous part, that you have to look at it in terms of the EBITDA margin. So they have much higher EBITDA margins, so they deserve much higher price to sales ratios as well. On the other hand, you may say that Alphabet has a much higher EBITDA margin than Amazon, as we saw earlier. So why is Alphabet's EBITDA margin, price to sales ratio not much higher than Amazon's? And so that might give an indication that Alphabet is perhaps undervalued. But let's also take a look at each of these businesses in their historical context. So first up, let's look at Amazon, Facebook, and Alphabet. So you can see that Amazon's price to sales ratio is about 4.2, Alphabet is about 5.0, and Facebook's is about 7.89. So you got to look at it in the historical context of each business. You can see that Facebook has gone down quite a lot in terms of its price to sales ratio, from as high as 18 over here to 7.8 now. But of course, the revenue growth rate has also decreased for Facebook. So some of that is probably warranted, but is it completely warranted? That is the question, actually. And you can see Alphabet. Alphabet has ranged between 4 to 6, and then 5, and 4 here, and then 5. So it's always been in this range of between 4 to 5 plus. You can see that, of course, during the last crash we had, it dipped to about 3.76. Right now it's about 5.0. So before the crash, it was about 5.73. So it's still a bit lower than what it was pre-crash, but it's much higher than what it was during the crash. In terms of Amazon, Amazon actually is the opposite. I think it's gone up a lot. I think a lot of that is justified because of the spike in revenue growth that we saw. You can see pre-crash, let's say around here it was about 5.6, sorry, about 3.7. Then it dipped all down way down to 3.3, and now it's about 4.2. So it's higher than where it was during before the crash. Let's also take a look at uh, the valuation metric for price to sales ratio with 1 year ahead. So that will give a better indication also of how their valuations compare once the crisis is over. So you can see that Amazon drops to 3.6, Alphabet drops to 4.9, and Facebook drops slightly to 7.5 as well. So the further out you look, the cheaper these stocks seem to be. So next, let's take a look at Visa, MasterCard, and Intuitive. So Visa has a current price to sales ratio of about 18.7, MasterCard slightly higher, 18.78, and Intuitive at about 15.25. So pre-crash, MasterCard and Visa had a price to sales ratio about 21 and 22, and Intuitive had a price to sales ratio about 16. And during the crash, Visa and MasterCard were about 13 and 14, and Intuitive was very cheap at about 9.8. Intuitive has recovered quite a lot, and so have Visa and Master. Up next, let's look at the final four, Alibaba, Adobe, PayPal, and Autodesk. You can see that actually Adobe and Autodesk actually have higher price to sales ratios than they had before the crisis. They certainly had a V-shaped recovery in their valuation. And so has PayPal. PayPal's price to sales ratio has shot up to 9.7 compared to where it was before the crisis. It was about, let's say in Feb, it was about 6.91. But Alibaba's has fallen quite a bit. Alibaba was about it was as high as 9 in December, and now it's fallen to about 7.66. So the price to sales ratios come down a little when you look at the price to sales ratio 1 year forward. So you can see that Alibaba now drops to just 5.998. PayPal is about 8.8. And Adobe is about 14.4, and Autodesk is about 12.91. So what catches my eye is Alibaba actually, with the kind of operating margins it has and the kind of revenue growth it has, and especially once the virus is over, it seems pretty low at 5.998 for a good quality stock like that. One of the reasons it's probably so low is also because of the fear of Chinese companies. But I have also the opportunity to buy the shares in the Hong Kong market. So that is probably something I may want to consider. So looking forward and looking at the price to sales ratio 1 year forward metric, I think you can certainly make a case that some of these stocks still look a little undervalued. In particular, I would say that Alphabet probably looks a bit cheap to me. Alibaba also looks cheap to me. Overall, this is the picture that we get in terms of their valuations. Which do you think is the cheapest among these stocks, taking into consideration their revenue growth rates and their EBITDA margin? Let me know in the comments section. If you would like to be a patron and a supporter of the channel, jump over to our Patreon website, and you can subscribe to one of our membership levels. You can also gain personal access through me and also my immediate thoughts and actions in the stock market through Discord at about $5 per month. We look forward to seeing you on the Discord chat.